Alright, today is Wednesday, October 14th, and this is a post-market review for the stock market activities today. You are looking at the agenda of the day. We will cover the usual. Plus, we do have coverage on the earnings of United Health, United Airlines that just came out after the bell, and of course, we do have some banking earnings from Goldman, Bank of America, and Wells Fargo. We will look into all of them in details. Furthermore, we do have charts for the SPY, the Qs, the dollar index, the VIX, Apple, and Tesla. And here we go, the Dow Industrial Average in the red by 167.81 points or 0.58%. The Nasdaq in the red, 995.17 points or a decline of 0.80%. The S&P 500 in the red, down 23.26 points or a decline of 0.66%. What's going on with the sector's performance? Pathetic. Just like yesterday, we are not going to give any metals today, even though we have basic materials, industrials, and utilities managing to close in the green today. However, leading the laggards of the day, real estate having a tough week so far, consumer, cyclicals, and communication services. Moving on to the futures market performance. Crude oil in the green today, and look at that, a rebound in lumber, sugar acting sweet today, lean hogs, aka the new tech, no stopping sign, took a little break, and here we go. The sky is the limit. Good day for grains across the board, no exceptions. What about the laggards of the day? We do have platinum taking a hit today, so did OJ. Both platinum and OJ facing technical resistance on the charts. And moving on to the big casino, the options market. Here we go. Apple at number 1, 2.1 million contracts traded today. 70% of those were calls. NEO at number 2. And by the way, nobody's buying NEO shares. Everything is done via options. Evident with 2 million contracts traded today. 81% of those were calls. If you've been watching and following the options market action today, we saw a ton of activities regarding NEO stock. And of course, the excitement about electrical cars are being recharged, so why not Tesla, number 3, with about 1.17 million contracts today. A significant pump for Tesla stock via options, of course, and you saw Tesla outperforming today. 72.5% of those were calls. Let's take a look at the volume leaders. Nothing new here. Apple, NEO, Tesla, they're just rounding up to the next number, expiring, of course, this upcoming Friday. What do you do with this kind of information? Well, look at a trade like the Tesla 500. The probabilities and the math is on your side as a seller of the Tesla 500 call, the delta, the theta, all on your side. So when you see a stampede like this, you could take opportunity and take advantage here and write some Tesla 500 calls, assuming of course you do have the stock in your portfolio. You don't want to write a naked call at any time. Absent of a gamma squeeze, you will collect the cash. What is happening regarding the open interest? Starting with the increase in open interest, right away caught my eye American Airlines, the $20 put expiring January 21. We've seen a few earnings here from the airline sector, specifically Delta, and today after the bell United Airlines, and the picture is not getting any better without the stimulus. We do know that American Airlines is the weakest link, and I do agree with this trade that American Airlines will suffer more than any other carrier, and perhaps if there is a future of bankruptcies in this sector, American Airlines will be the first in line to wave the white flag. Moving on to the decrease in open interest. Very interesting right here. The Apple 110 call expiring next week. Now this call is in the money. So why are they closing it? The bet here is Apple will trade under 110 next week, meaning that traders are seeing further downside and perhaps an accelerating downside in Apple's shares coming very soon. Now, let's move on and review some interesting trades we found out in the options market today. Number one, we do have Philip Morris, the tobacco business. They're buying the 8250 call. This is of course expiring in November. We do know that there is a recovery in China, and China is pretty much the biggest tobacco market right now. And if people are gonna go out and about, guess what? They want to smoke cigarettes. So perhaps we will see a rebound in the tobacco business. Anyways, another trade about a name I do have in my portfolio, Kroger. Kroger was down significantly today, over 4%, on the heels of a downgrade from Wells Fargo of all places. And the thesis here for Wells Fargo is that the COVID momentum is starting to slow down in Kroger. We do know that Europe is facing a second wave of COVID, and it is a matter of time before we face one here in the US. That would be good for Kroger. So what did I do? Buying calls today on the dip. Those calls are already up 100% today. By the end of the day, they already doubled in value. And I also sold the puts, the ones they're buying here, the 32 puts expiring October 30th. Meaning if the stock goes below 32 by expiration, I will be able to add more to my position at the 32 price. Moving on, you know what happened today with Fastly after the bell? Down over 20% last time I checked. Well, guess what? Today, somebody sold the 135 calls expiring December using the proceed and bought the 120 put expiring January. Somebody knew ahead of time what will happen to Fastly stock, and that somebody is rolling in cash as we speak. Moving on to the heat map analysis. Right away, you see the big boxes of tech underperforming today. Exception, of course, Apple. Apple has a support level, the 120, very sticky. But once it breaks that level, you bet that you will see Apple flushing down. Just we saw Amazon today. We talked about PayPal, Square a few days ago. Today, they're giving up some of the gains they had earlier in the week. And you see banks across the board, horrible earnings from Bank of America and Wells Fargo, having a significant effect over the entire sector. And you see, of course, United Health, UNH, in the healthcare sector, down big in the red. They had earnings today. The earnings were actually very good. However, the stock ran ahead of itself way before the earnings were announced. You do have to keep that in mind when you're trading. When a stock runs ahead of itself before earnings, the probability is that even if the earnings will produce good news, it is already priced in the stock, and you will see a correction right away. This is exactly what happened in United Health. You also saw AstraZeneca, AZN down big today. All these vaccine manufacturers are having a tough time with trials. We talked about Johnson & Johnson yesterday and Eli Lilly. Today is AstraZeneca having a tough time with their trials. In consumer defensives, you see groceries are down, specifically Kroger. We talked about that. What about communication services? We saw gains in T-Mobile yesterday. Well, it gave it all up today. T-Mobile trading in the red significantly today. Likewise, Disney and Netflix saw gains earlier in the week. Today, not a good day for both names, trading in the red. And of course, you see the theme of the pumps and dumps quickly. All of these, of course, are done via the options market. And we see the outperformers today. We do have some few bright stars. We're talking about Qualcomm in the chip sector. We're talking about Baidu, Tesla, and the entire industrial sector, specifically, of course, railroads. And now let's move on and check on the rotation trade and see what's going on. Right away, you see muted action across the board, declining. However, you could say that the comeback stocks are outperforming just by a little bit today. And in the momentum side, you see, of course, Tesla outperforming, due to the action in the options market. A significant surge in the volume of contracts equals a move in the underlying stock. We're talking, of course, about call options buying. On the other side of the aisle, you see Cisco outperforming today, big gains over 2%. Rebounding, of course, from earlier losses in the week. And now, to the headlines that shape the day, plus earnings reviews. Right away, what's going on with the stimulus fiasco? We saw an interview that went viral from Nancy Pelosi on CNN, and she was absolute wackadoo and a psychopath. In that interview, she was attacking Wolf Blitzer, the host, for asking simple and honest questions, and you could see from her tone, she is not interested whatsoever in a stimulus deal. She's just interested in dragging this along the way because it is a no-brainer. We talked about this before. The Democrats have no incentive whatsoever to hand the President Trump a victory just a few weeks before the elections. Why the hell would they do that with no exchange whatsoever? And right away in the morning, we heard from Slimy Mnuchin, who said that the probability is that we're not going to have any stimulus deal before the elections. He did talk earlier in the day with Nancy. Nancy rejected a carve-out deal for airlines. She said all or nothing. And of course, the market sold off just a little bit based on that news. We will digest the news right now after the market, and perhaps you will see the impact more clearly during tomorrow's trading activities. And of course, we heard from the Fed Vice Chairman Clarida, and he sounds very pessimistic here, saying that there is a long and uncertain road for recovery for the economy from this point on. We heard some Fed personalities like Bullard and even Kaplan downplaying the impact of the recession. And of course, Bullard doesn't think it is a recession to begin with. But here we hear from Clarida himself saying that the picture is not as rosy as we've been telling people. That's all there is. Nothing unusual here with the mixed messages from the Fed's personalities. And of course, we've seen inflation rising. We had the data in the morning today. And you see, when you measure inflation, the core price inflation, seasonally adjusted, we are now reaching and recovering all the way back to pre-pandemic levels. This is not good news because consumer spending and consumer power and the employment picture are not recovering as fast as inflation. This increases the risk of stagflation in the economy, a 70s-like environment, and I think that the Fed has no clue what they're doing. Of course, everybody, the experts, are assuming that the Fed's policies are deflationary and increasing inflation is pretty much impossible in the economy, so there is no risk. And now we're looking at the data, and we know that inflation could get out of hand with the current policy of the Fed, especially when you factor in expectations of a declining dollar, and you see, of course, imports surging in our ports, and that would certainly accelerate the inflation picture. We could talk a lot more about that, but we do have a lot of topics to cover here, so we're moving on. And we do have earnings we heard in the morning from United Health. United had a pretty decent earnings report. How could they not? They're running a racket, a legal racket protected by the government. This is pretty much the summary of the healthcare business in America. Needless to say, they're raising their profit forecast for the year, and when you dig down into details, you see that their core insurance business is up 5% year over year. However, the growth and the surprise here came from their online pharmacy business, the Optum X. This business came out up 21% year over year. Significant surge in the revenue from the online pharmacy business in United Health. And since we're talking about United, let's talk about another United Airlines, that is reporting earnings right after the bell. And from what we know so far, is the revenue and net income came worse than expected. However, the cash burn, they managed to reduce the cash burn from about 40 million bucks a day to 25 million bucks. That is still a massive number, especially when you compare it to Delta. However, United CEO says they do have enough cash to go through the COVID crisis. I call bullshit, and we will see how the shares react tomorrow. If they do have cash to go through the COVID crisis, then why are they begging for more stimulus? In my humble opinion, these results are disastrous. And now let's move on to the bank's earnings, starting with Goldman. Goldman, of course, had a very good earnings report as predicted, and I told you that I'm bullish on Goldman Sachs and Morgan Stanley due to the surge and the boom of trading, aka stock market gambling. And you see their trading revenue up 29% year over year. And when you do include bonds trading, the revenues are up 49% year over year. Very impressive for Goldman right here. And as you can see, these are the segments for their revenue lines. We will take a look at each one of them and look at the growth. All in all, the growth in each segment increased significantly year over year, but not quarter over quarter. Of course, because the second quarter was an exception, we saw significant surge from the bottom. So we're not going to look at the quarter over quarter as a judgment for Goldman's results. We look at the year over year. And of course, before we start looking at that in details, let's take a look at their revenue across different geographies, doing very well year over year, increasing specifically in the US. But here we go, net revenue. And you can pause the screen at any moment here if you want to read the commentary from Goldman. But I'll go real quick reading you the year over year change. Net revenue up 30% year over year. How about investment banking? Up 7% year over year. And when we look at global markets, up 29% year over year. And here is perhaps the most impressive segment, the assets management. Of course, we do know that the stock market did very well so far, specifically in the third quarter. And you see Goldman up 71% year over year. Likewise, when we look at the consumer wealth management segment, up 13% year over year. And when you do have impressive results as Goldman, you don't need to allocate lots of provisions, as we will see with Bank of America and Wells Fargo. The provisions came to $278 million, of course down year over year. Now, it is a different story when JP Morgan, which has more risk exposure, lowering their provisions versus Goldman, which has less risk exposure, lowering their provisions. I can accept Goldman's provisions, but JP Morgan is a little worrying and concerning given the fact that they're involved in retail banking. Moving on to Bank of America. And the story here, of course, and the reason why you saw Bank of America shares crashing today is the net interest income down 17% year over year. And of course, it was down quarter over quarter as well. Now, Bank of America says that Q3 is the bottom for net interest income. However, the market did not buy that, and you saw the action in the shares being very evident today. Bank of America allocated about $1.3 billion this quarter for provisions, and as you can see from their results, that the net interest income is the most concerning element here, down year over year and down quarter over quarter. Not a good picture here because the assumption was that the net interest income would be down year over year, granted, but it at least would be up quarter over quarter. That did not happen, and it was a big disappointment for the stock. And of course, we do have the net charge-offs. This is, of course, for bad loans or loans where banks don't expect to collect on these loans. And you see that the net charge-offs are still very high for quarter three. You'd expect the charge-offs to go down a little bit, especially when they're selling us a story of an improving macro and microeconomic picture. What about commercial banking? Well, the good news is the revenue up quarter over quarter, but it is still down year over year. And of course, as we've heard from JP Morgan and the rest of the banks, the trading revenue for Bank of America is up year to date. However, it wasn't enough to offset all the bad news, specifically from the decline in net interest income. Lastly, here is a chart from Bank of America that provided this for us. Very interesting to see that customers are using their debit cards, and you see that recover to pre-pandemic levels. However, we're not seeing the same thing with credit cards. And that is the same picture across all banks. And until and unless we see a recovery in credit card usage, it will continue to add pressure on banks' results. Of course, they keep telling us that consumer confidence is rising and consumer spending is rising, but when you look at the data from the bank itself, it is telling you that there is no consumer confidence. If consumers were confident, why wouldn't they use their credit cards? They're afraid to do so because they don't want to add to their debt in such uncertain times. Moving on, across the street to Wells Fargo, and it is not a good visit. If you thought Bank of America is bad, wait till you hear about Wells Fargo. It is a disaster. Net income down 19% year over year. That's not all. Of course, their net interest income is even worse than Bank of America. And they're saying it is down $512 million quarter over quarter. And from the statement from Wells Fargo, it is a no-brainer that the Fed's policies of low interest rates are starting to hurt the banking sector. You also see that the commercial loan balance for Wells Fargo is down year over year. How the hell are they going to make any money when they can't make it from the Fed due to low interest rates and when their commercial loan business is stalling? Furthermore, and perhaps this is a bigger bomb here, indicating that perhaps Wells Fargo would need to allocate more to its provisions in the future. Speaking about credit quality, they're saying that the COVID deferrals makes it harder to figure out the net charge-offs and the delinquencies due to a delaying effect. So perhaps in time, after all the delays and the forgiving periods are done, when you unveil the picture, you will see more delinquencies and more bankruptcies Wells Fargo's loans. And the picture here is absolutely miserable for the bank. It is not investable whatsoever. The amount of uncertainty is just too much to even consider an investment in the bank. And now, let's move on to cover some charts, the technical analysis. Starting with a SPY 15 minutes chart, we do have the support of 346.85 in or around that area, but we are also forming a bear flag formation that could eventually takes us all the way back to the first gap when we look from a daily charts perspective. And that first gap is around the level of 329. Of course, we're not going to do that in a straight line. It is possible, but we do have a lot of levels of support to watch out for where the SPY can hang out for a break or even a rebound before continuing the journey to the downside. Now the question is it possible that this is just a retreat after a massive run and we're just going to continue marching to the upside? I do doubt it. That is not my consensus view. My view is we will reverse. All that gapping that we did on the way up will translate to an air pocket. We will flush down and we will close gaps very rapidly. Moving on to the Qs, the Nasdaq, 15 minutes perspective. We talked yesterday about the bear scenario of having lower highs and lower lows, and you see of course that playing out. We didn't even bother go to the resistance. We reversed before doing that. That is very bearish behavior. And now we're forming a bear flag formation. As you can see, the trend line is a little sticky. It is a strong support, and the Qs will have a battle to go through before breaking down from that level. It could do it as a gap down tomorrow, so watch out for the futures chart. When we move out to a daily perspective, the big picture, here you can see my projection of about 2.2% decline, going back to the gap we did 3 trading days ago. That is of course a minimum destination for now, and then we'll take it from there. Moving on to the Dixie. And as you can see, overnight the Dixie managed to catch support from the 93.50 level, not just once, but twice. However, it hit a double top formation. This is a 15 minutes perspective, of course. And during the trading day, you saw it flushing down, and now it is forming a bear flag formation. This is, of course, looking at the glass half empty if you are a dollar bull or if you want the dollar to rise. Now looking at the other half, switching to a 1 hour chart for the Dixie, you can see that no harm was done from today's activities. All what we're doing is a cup and handle formation, catching support from the 93 level 3 times, moving higher, recapturing former support of the 93.50, failing below it, catching a break, recocking the gun, and then moving and marching higher again. We will see which scenario wins, perhaps by tomorrow. By tomorrow morning, it would be very clear which direction we're going in the dollar index. Now, let's take a look at the VIX. Nothing new here. The VIX caught support from the 95 level multiple times, and we saw the VIX trading in the green today. Nothing big. And of course, you have to pay attention to the put to call ratio in the VIX because the morons are still shorting the VIX. Even though we are heading into an election season. Historically speaking, the VIX becomes elevated during the elections season. But don't try to bargain with the zombie traders or going all in, not just buying the Qs, but buying the T-triple-Qs, the Ultra Pro Leverage Index, shorting the dollar, shorting the VIX. They're all in. And when things go against their way, you will hear the pigs squealing for miles away. Moving on to Apple. What's going on with Apple? From a 15 minutes perspective, we talked about the double bear flag yesterday, and you saw it playing in the morning. However, the 120 level remains very significant. And you saw Apple catching support repeatedly from the 120 level. Now understand that breaking 120 will cause a flush of at least a decline of over 2% in Apple's shares. You saw other big tech names such as Amazon declining over 2%, yet Apple managed to close in the green just by a little bit due to the significant support of the 120 level. Moving on to Tesla. What's going on with Tesla from a 15 minutes perspective? We talked over the weekend about the 453 level as a significant level for Tesla, and today was the day where Tesla managed to beat the level and trade above it. Of course, due to the call options buying today. A big surge, over 1 million contracts traded, and you see the impact on the shares of Tesla. However, looking at the chart, you see that we are creating a new trend line, and we are diverging just a little bit higher from the trend line. So it is not a surprise if you wake up in the morning and you see Tesla down 2%, revisiting the 453 level and the trend line before bouncing higher, assuming of course that it will bounce higher along with the market. But if we see the indices flushing down, it will be no surprise that Tesla will flush down as well. And now let's move on to conclude this video. Today was another day of evidence of the complacency and the lack of panic in the market. We are pretty much certain now, specifically after the comments from Mnuchin, that we are not going to have a stimulus deal this year, because even if the blue wave scenario happens, the stimulus is not going to take place until next year, meaning that earnings for the fourth quarter will be abysmal for a very long list of businesses that relies on consumer spending. Combine that with the fact that we've taken valuations for companies out of whack, pricing in a stimulus. So when we don't have a stimulus, the natural and the reasonable conclusion is we do have a repricing and a massive sell-off and a decline in the market. That didn't happen yet today. Perhaps it's the natural reaction of the shock, the delay, the lagging effect, because we did not see the dollar rising today. We did not see yields declining today. So there were no indications of panic whatsoever. And traders continued to march on, shorting the VIX, shorting the dollar, going all in, buying Apple calls. However, and this is a very important development, after the bell, we do have Fastly declining over 20%. Now, Fastly is a small name. What are you talking about? It's not going to have an impact. Hear me out. The Robin Hoodiots are in control of the market right now via the options market and via margin trading. When Fastly drops down overnight 20%, one of the Robin Hoodiots' favorable holdings, guess what? Margins will be called. Now they have to liquidate some of their other positions to cover the margin call. Furthermore, it is a big defeat and a hit, a massive Mike Tyson-like punch to the morale of the Robin Hoodiots, who felt that they're invincible and their strategy of putting a blindfold, going Naruto style, stampeding, buying stocks before even hearing the facts, regardless of the facts, regardless of the technicals, regardless of the news, just buy. Today was a massive defeat to their morale, and they will start to become more fearful and panic regarding their other holdings that went out of whack. So I do see this as a pivotal point, paving way for a bigger correction when you combine the Robin Hoodiots finally getting a dose of reality, plus the elections uncertainty. Everybody who was assuming that there is a blue wave and Trump is gone, be careful because the polls will get tighter. You combine all that information and it is no brainer that a correction is looming very, very near. If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.